You think investment conferences are boring? Mostly they are. But how about this one? Let's put 4,000 investment professionals on a beach for 4 days and let's see what happens. We are on a beach. Look behind me. We're in Huntington Beach, California, for the Future Proof Conference. The conference organizers say they are seeking nothing less than to try to redefine the financial conference business by emphasizing social interaction with cool cooking and wine classes and a lot of very serious content like how to deal with cybersecurity threats. All this topped off with a rock concert from Third Eye Blind. Sounds like fun? It is, actually. The ETF industry is here in force, and they're trying hard to connect with younger, independent investment professionals who don't necessarily want to go to traditional, boring conferences. You see, it's a very interesting stew here. So let's find out what some of this is all about. My guest today, Marlena Lee, here on my left, Global Head of Investment Solutions at Dimensional Fund Advisors. Jan Van Eck, my old friend from Van Eck, CEO of Van Eck, and John Mayer. He's the Chief ETF Strategist at JP Morgan. Jan, this is the third year. I think you've been to all three, haven't you?
Just last year.
Yeah, okay, so you've been to two.
But it's exploding in size.
Well, tell us a little bit about what's going on here. What are you seeking to get? And the organizers say they're trying to do a new kind of investment conference. Does this feel new or fresh to you?
Well, the magnet, right, that brings everyone here to the beach, to this beach, I think, is Josh Brown and the Ritholtz people and their podcast coverage listened to by a lot of RIAs. So I think that's the magnet. There are a lot of trends going on with registered investment advisors, independent advisors. One is the explosion of large advisors. It used to be an advisor that had $1 billion under management was big. Now there's some with $200 and $300 billion under management. I mean, that's really big. And then the second thing I like to comment on is just the use of model portfolios, which is people not really picking and choosing their own ETFs, but choosing a bundling of ETFs. And I think all three of us are involved in that to one extent or another, and it's driving, some estimate, up to half of the flows in our industry into ETFs.
So Marlena, you know, this is all about sort of connecting, it seems like, with these younger RIAs that Jan was talking about. You have had a lot of success, Dimensional's had a lot of success converting to ETFs. You're I think the 7th biggest provider out there. We've got 155 billion, something like that, in assets under management. Your philosophy, Dimensional's philosophy, is essentially, I call this indexing plus. Maybe you have another word for it. It's indexing with factor overlays like value and size. Does that message that you have behind your investment philosophy, does it resonate with these younger RIAs? Can you explain what you're doing to them?
Oh yeah, I think so. And you can tell the story in flows, right? So active ETFs are the biggest growing segment of ETFs. Dimensional is the #1 active ETF issuer. But even though active ETFs are systematic active, if you want to say, more of the factor-based approach, even though we're only still 8% of ETF assets, almost 1/3 of the flows are going into active ETFs. So it's certainly something that's resonating. I think the reason it's resonating is, you know, it's great if you want to invest in a plain vanilla index approach. But I also think that some people are realizing that there are some inefficiencies associated with it, some hidden costs, and having an approach where you can have really well diversified portfolios, low turnover, but also have a chance to outperform the market in a really reliable, robust way. That's the name of the game.
Yeah. Just to be clear on this, I have a little bone to pick with the industry when they talk about active, and that's active. Systematic is a correct way to look at it. When I think of active, I think of old school, you know, alpha generating, stock picking guys. In here, when you say you're active, you're indexing, but you have a systematic method where you look, for example, like for value, look for small cap. That's systematic.
Such a great point, Bob, because yes, we're actually not indexing. Because the point of an index fund is to just track the index. So they're actually prioritizing low tracking error. Yeah. And because of that, they're forced to buy and sell at certain times. There's inefficiencies associated with that. Instead, there's a better approach, and it's all based on, you know, more academic research. And instead of being active to try and pick stocks or time markets or figure out just what's over or undervalued, we don't believe we can do any of that at Dimensional. Instead, we're relying on, you know, decades of academic research to say what areas of the market have higher or lower expected returns, have had those returns show up over many, many decades, and pursue those. So that's as you pointed out, small cap stocks, value stocks, and stocks with higher profitability all tend to outperform.
Yeah. John, let me bring you here. A huge year for ETFs. We now have, the industry has $10 trillion in assets under management. I mean, really, that is quite an accomplishment. But it's not just inflows into low-cost index funds, as Marlena was pointing out. The ETF industry has been on a massive product development binge this year. Marlena referenced active ETFs, but we have synthetic income stuff. Your JEPI was an enormous hit for the last couple of years. We have buffered products, we have leverage and inverse products being introduced. Give me a high-level picture. You're one of the thought leaders in this space. Where's the ETF industry going right now?
Well, the ETF industry really, Bob, has changed over the past 5 years since the ETF rule, which really leveled the playing field for all market participants, whether if I, John Mayer, wanted to come to market and start my own company, or JP Morgan, or Dimensional. It made it easier to come to market, and there was more tools available to managers to manage capital gains inside of a portfolio. Since over the past 5 years, we've seen 1,700 ETFs come to market. 1,200 of those ETFs have been active. And now the reason that's the case is because some of these changes, and also there's just this great pool of talent out there in terms of active managers, whether it be equities or fixed income, to leverage. And the investor now has so many more tools and options available to them. You're seeing fixed income. Fixed income is an area that is just seeing a tremendous amount of trends flows right now. It's because of the rate environment. And that likely will continue. The Fed is probably going to cut rates either 25 or 50 basis points later in the week. Money market funds, there's about $6.5 trillion in money market funds. Much of that will flow into either longer duration fixed income or some in other areas of equities. But what you are seeing is there's just a lot of different types of products out there and more availability to the end user. And that's the real difference over the past 5 years, where the number of issuance has really doubled.
Yeah, it's confusing to the viewers. That's the problem. Now, when you're dealing with north of 3,000 ETFs, John, the average viewer says, all right, so I have an S&P, I have a mid cap, and I have a small cap value fund, and do I need an options overlay program on top of it? It's confusing navigating, and this is why this program exists, actually, because we saw a need to try to explain to people what these products are all doing. You've been one of the most, those who don't know, you should know, Van Eck is one of the most innovative of the ETF people. You own a whole bunch of suites of different products, semiconductors and gold, and you started out as a commodity. Jan's family has been in the commodity business for ages and ages. Where do you see the business going? I know it's easy to just say active, but you also bring out innovative products yourself.
Yeah,
niche products.
Van Eck's investment approach is what I call macro, which is sort of trying to talk to investors about what are the biggest concerns that they should be having with respect to their portfolio. So number one, fiscal spending in the US is going to be a big deal over the next 12 months. Can the government continue to stimulate the economy and spend so much more than they're taking in tax receipts? Our answer is that's going to cause a lot of uncertainty. Gold and Bitcoin are great hedges for that, and that's what we're talking to investors about, number one. Number two, there are a lot of rules, I call it systematic or rules-based strategies. We have one as well, our wide mode ETF, that has to look through the market environments, right? The market was very distorted about a month ago. Mega cap tech was really way too much of the performance. And if you just allowed the market cap S&P to guide you, I think that's not enough. All three of us have different answers to that question, but just buying the S&P alone, I think is a dangerous strategy right now. You have to really have a more diverse set.
The over-concentration is a real problem.
I think it is, because you saw at the beginning of this quarter growth so extended versus value on a historical basis. It was almost like it was
high on the S&P right now. It doesn't.
We just, listen, I just call it. It was growth versus value was like it was in 1999. Yeah. Like they only ring the bell a couple of times, but when you can look at a multi-decade chart and say, wow, that really stands out. So anyway, I think investors should look at their equity book and say, how should I construct that to ride through the cycle of the next year?
Well, let's look at your fund. Your biggest fund is
very much dimensional.
The Core Equity 2, right?
Yeah.
This has a small cap and a value tilt, but its largest holdings, you look at it, still mega cap tech is there. maybe not in the proportion of the S&P, but it's Apple and Microsoft. I know we could put that up. Apple's 5%, Microsoft's 5%, NVIDIA 5%, Meta's 2% here. Your investment philosophy, though, still very much believes that in the very long term, value will do better than growth.
Yeah.
Of course, small cap will outperform. But with a very few exceptions, that hasn't happened in 15 years. So the viewers go nuts about this. They always message you, Bob, what is it with this small caps outperform value, small cap outperform big cap, value outperforms growth? Why don't we see it? Why don't we?
Well,
what happened?
First, we don't see it in the U.S., mostly because of some of what Jan was just talking about. We have had just a tear in the returns of some of these large growth tech names. But that's a U.S. specific story. So if you have a globally diversified portfolio, which I absolutely recommend for all of the investors, is they be diversified. Small premium, value premiums have shown up outside of the U.S. very strongly in the recent periods. So it's worked there. Where it hasn't worked is the U.S., mostly because we do have these names that have just done really well over the last 10, 15 years. But that's not to say that they'll continue to do well. In fact, when you look at their prices today, their valuations, usually that means that they're going to have lower expected returns on a go forward. They probably have some very high, lofty expectations around future cash flow growth as well, but that's already built into the price. So, you know, the example you gave, DFAC, it holds everything in the market, almost everything. And we do try and weight them a little bit differently than how you'd hold your market portfolio, just because it doesn't make sense that all stocks have the same return. And we want to.
Do you buy into the idea? You know the ETF haters, what they say. You know, I'm a famous value fund manager. I used to make a lot of money in value. If I bought a stock for $10 and thought it was going to be 12, it would go to 12. Eventually, I'd be rewarded. Now I'm not being rewarded. Why is this happening? Why am I not being rewarded as a value investor? It can't be because my methodology is wrong. I'm a genius. It must be because there's something wrong with the market. It's got to be those people reflexively buying, you know, those silly plain vanilla S&P 500 because it's got a growth tilt, and that's what's ruining the value play. Does that make any sense to you?
Well,
these are the haters. Remember,
they are the haters.
They don't like passive funds because it's taking money away from them, and they feel it's ruining their play, their game. Is there any truth to any of this?
So I love the flow of assets into lower cost solutions, because I do think that lower cost solutions are better for investors than really expensive ones. Do I buy that that's why we're seeing a lull in the value premium? It doesn't explain the flow of returns. So as Jan pointed out, we've seen these valuations before through the tech boom, bust. We've seen very weak value premiums or negative value premiums, very strong value premiums. All throughout, we've seen a growth in index funds. So I don't think the pattern really matches the data, or the explanation matches the data at all.
Either one of you, there is an interesting academic question around how much would it take for passive investing to so dominate the market that it becomes less efficient, that active players can't influence the market. It's an interesting academic question. It seems to me that we're not even close to being there yet. I just want to give you a chance to respond to what we were just saying here.
You know, I think ETFs play a significant role in our overall marketplace in terms of liquidity. So I looked at ETFs as a percentage of overall volume, overall market volume, and over the past 15 years, it's been about 28%. Now, during periods of extreme volatility, like the energy crisis, taper tantrum, or say COVID, you'll see the ETF as a percentage of overall volume spike, along with volatility. And what that tells me is that the market is absorbing the liquidity through the ETF structure. You look at what happened during COVID. The Fed purchased high yield ETFs, investment grade corporate ETFs, because the underlying prices, there was none. So the ETF became that price discovery mechanism. So I would argue that ETFs are adding liquidity to the market, not subtracting liquidity to the market. And that's something that is so misunderstood. To your point earlier, it's not sapping liquidity from the market.
Well, indexing doesn't mean long and hold by only investors.
Yeah. Well, we saw, I know you want to jump in, but we saw this when the haters said, oh, these stupid products, they've got these bond funds that have illiquid bonds in them. Wait till anything happens. It's all going to seize up because the market makers aren't going to be able to create and redeem. the shares. Well, it turns out actually that wasn't true. The market not only functioned, the tail wagged the dog.
Yep.
It was the ETFs that set the prices, and we saw this with the Chinese market. When the Chinese market was closed, the ETFs here in China, the China ETFs traded as if there was an underlying market that was still open. It was magical. It really worked, but it turns out it's a very efficient pricing. The market gets it directionally. You want to jump in?
Yeah, I think that, right, ETFs add liquidity to markets. They trade tighter often than the underlying, so I think that whole argument is not that interesting anymore. But one of the big things, I was at the All-In Summit last week, and one of the things that one of the presenters from Co2 talked about is there's 1,400 private unicorn companies, so 1,400 companies worth over $1 billion. Why are they not going public? And the one fault about ETFs is they don't buy IPOs, right? So with the death of active management, who's buying IPOs anymore? Right. Like, who has that discretion? And a number of hedge fund guys have talked about that. I think that's a very interesting discussion. It's hard to kind of prove anything, but I asked a group of like 60 people last week at a client conference who'd bought an IPO in the last year, 5 years, and one hand went up. No one's buying IPOs.
Yeah, well, that's a separate question. We need to get more IPOs. John, I want to ask you about international investing because Marlena referenced this briefly. JP Morgan has a great suite of international products, beta builders out there that invest in Europe, they invest in Japan, they invest in Canada. You've got a whole big suite of these ETFs out there. But the inflows into international funds really have been pretty modest. In fact, negative in some cases. Everyone is just interested in the U.S. Why can't we get any investor interested in international?
Sure. Well, first of all, everything's a cycle. And right now, the U.S. is doing rather well, and we're going to be in an easing cycle. So small cap companies are going to be benefited by lower interest rates. But international is an important part of an overall portfolio. And we are seeing flows into our international funds. Ones that they're active and they take small bets in terms of not huge tracking error, approximately 100 basis points of tracking error. And I think dipping into international in a balanced portfolio is certainly relevant and important. Most of our clients are in the US, but you typically have some exposure to international, whether it be emerging markets or developed, as well as fixed income. So I do expect flows to continue in international, picking up a bit. We are seeing fairly strong flows, though.
Doesn't it make sense? Flows follow prices, right? I mean, people are trend followers. The price has not been good, and Europe's been flat. Japan's had a good year. China, mainland's been terrible this year.
But that sets up great bull markets, right?
Yeah.
These cycles are long. They can last 10 years plus. But then people completely hate asset classes. They forget about them. It's impolite even to talk about like natural resource equities or small cap value or whatever it is. And that sets up a great bull market, right? You want the last seller to be out of there. And so I think that these cycles are long. People get frustrated. I get it. But
I have to say, looking at China, I mean, this is sort of a vicious loop there going on. The economy is not in good shape. People don't seem to have a lot of confidence in real estate or the stock market. The savings rates are through the roof there because they don't believe in investing.
They are on the cutting edge of so many technologies, Bob, and that was what's been missing, I think, in a lot of conversations. Electric vehicles, solar, now nuclear, driverless cars. We talk about 2 cities having driverless cars. I saw some in San Francisco recently. They've got millions of users. Yeah. Like we are missing. I know the property market stinks there, and it's crushing commodity prices and lots of other things. But there's a part of the story.
So you're bullish on China?
No, but there's a part. I'm not saying investors can profit from it, but there's a story about China. I think that we are completely missing.
But how do investors profit from it if you're?
Eventually, those tech companies will be good. Will be good.
If I could put some perspective on just the size of China, it is a very big country. It has a very big economy, but in a global market portfolio, it's about 1%. So it is a tiny part of the market portfolio.
Is that market cap?
Market cap. So an MSCI ACWI index, for example. It's small. You put it into a balanced portfolio, it's even less.
Wow.
So we do have a lot of clients who feel one way or the other about China. And maybe they see growth potential like Jan. Maybe they see more risks than benefits. And from our perspective, you're not losing that much diversification if you decide to exclude it. I think that's why there's been a lot of flows into EMX China funds. just either because they want to carve out and they want a dedicated China manager, or because they don't want it in their portfolios at all.
Yeah, it's an ideological problem here with that. John, I want to ask you about JEPI. You had a big hit with JEPI. I don't know what it is now, 38 billion assets under management. This is the premium, the equity premium income ETF, folks, JEPI here. It's a synthetic income product, and you're still getting inflows, even though it's been underperforming on a price basis this year. The viewers love this product. Just explain simply how it works. What's the basic idea? It was the right product at the right time 2 years ago.
Sure, and I still think it's the right product now for the right type of client.
Wow, spoken like a fund manager.
JEPI is a covered call fund. It covers you have an actively managed underlying portfolio, and then you have an option overlay. And investors really enjoy income. And once they get income of 7, 8, 9%, they're very much attached to that income.
What you're doing here is you've got an S&P and you're selling calls, so you're collecting a premium. That's the idea.
You're collecting the premium, and you're selling some of your upside.
Right.
So
if it goes in the money, then you're giving up the upside,
yeah,
right? You get called.
Not full upside, and somewhat protection on the downside, because it cushions the downside. So
and when I say they're underperforming, I just want to make sure that you're collecting money. So if the S&P is up 17% and you're only up 7%, there's a premium, there's a dividend you're essentially getting there as well.
That's correct.
So, and people don't understand that about JEPI. It's a problem because people send me the chart and say, look, it's only up 7%, the S&P's up 17, it's underperforming. I said, yes, it's supposed to do that in an up market. However, did you add on the dividend? And what is the dividend? What would you get this year?
8% or so.
Well, there you go, right?
So
throw that in. See, people don't do that. They don't do that calculation.
That's correct. So one of the reasons that these assets are so sticky is that investors, again, as I mentioned earlier, they enjoy the income. And they are selling much of their upside, not full upside, but much of it. And again, they're somewhat protecting themselves from the downside. And the underlying portfolio is actively managed. Right. And there's kind of a
That's what I know you call it actively managed. I know we get that problem with
We believe, it is actively managed. Well, the underlying portfolio is actively managed, and the option overlay is very structured.
Yeah. The product made sense. The viewers love this. I got lots of emails asking about how it works, because investors who are smart say, I'm getting older, near retirement age. I don't want to pull out of the market, because you don't pull out of the market. That's a bad idea. I need a way to stay in the market and still have some protection. And that was the product that made sense. In 2022, remember we were down 18% in October 2022, folks? That's when this product took off. And everyone said, oh, well, there is a way to stay in the market and have some protection. So it made sense to me, and it made sense to people who flocked.
And I think it makes sense in the context of an overall portfolio. What are you allocating to income? What are you allocating towards growth and value, as well as more traditional fixed income?